there is a lot of great content to find when it comes to Forex, and all you got to do is search YouTube. There's a lot of guys putting out strategies, a lot of guys putting out good content, but there's 3 things that Forex YouTubers are not talking about. And in today's video, I'm going to reveal those 3 things to you. So let's roll that intro, run that disclaimer, and let's get it.
Have faith in your mind, have faith in your grind, invest in yourself, transform in your time. Have faith in your mind, have faith in your grind, invest in yourself, transform in your time. Trading get paid, trading get paid, trading get paid, trading get paid, trading get paid. Oh yeah, trading get paid.
All right, guys, Joe here, and it's time to trade and get paid. 3 things Forex YouTubers are not talking about. Now, there's a lot of good content if you search YouTube. There's a lot of stuff that you can find that will benefit you, and most of the time, it's enough to give you enough, right? It's enough to get you, like, to whet your palate. It's enough to kind of satiate your appetite a little bit to kind of keep you coming back. But there's 3 things that Forex YouTubers are just not talking about enough. They're not talking about it in depth. And if they are talking about it, they're not giving you all of the information. And so that's what I want to do today. Before we get into it, if this video gives you value and you learn something from it, would you go ahead and like it and consider subscribing to the channel? Let's grow the channel and continue to put out more educational content to the Forex community. People are looking and learning how to trade, and people want to take control of these markets, but the information is just not readily available. At this channel, Trade and Get Paid, we're giving education over entertainment. So help me to push this content out to more people. Like, comment, and subscribe. Let's get into the content. The first thing that YouTubers are not talking about is currency cycling. That's right, currency cycling. YouTubers are not talking about it, and if they are, they're not talking about it accurately or enough. So let's get into it. So look at this chart right here. I've got it drawn up for you. Imagine the base currency and the quote currency. Now, any Forex channel will tell you that the way we make money is that currencies fluctuate up and down. You can see here, if you look at the actual chart, you can see, you know, prices going up, prices going down, all this kind of stuff, and that's how we make money. When price goes down, we're short. When price goes up, we're long, and that's how we make money in Forex. But it's just not that simple. It's not just as simple as saying, well, price is going up, so we should buy, or price is going down, so we should sell. We need to know when to buy and when to sell, and there's more to it than just saying, when this line crosses over this line, or when this moving average, or when this pivot, or, you know, indicators are really not the way to go. So the way to go is to understand the strength of the market. So as you probably already know, the market works in base currency and quote currency. Like right now, we're looking at GBP, JPY. So the base currency is GBP, the quote currency is JPY. So for this illustration, or for this lesson, the blue line is going to represent GBP. The red line is going to represent JPY. So our base currency goes up and down when it comes to price. Now, price fluctuates on every currency. When price is going down on the base currency, generally you'll see the candlesticks dropping, especially if the quote currency is going up. If the base currency is rising in price and the quote currency is declining in price, then you're going to see the market to come up. You're going to see candlesticks printing an upward or bullish trend. So what happens, like how do we know when to get in? Because how many times, like, we see the market's going up and we get into a trade because, well, the market's going up, so we want to buy. We want to buy a bullish trend. But how many times have we gotten into a trade and we say, all right, cool, the market's going up. Maybe this move right here has got some, structure to it. We find some structure, we get in, and then it hits here and then drops, right? How many times has that happened to so many people? And so it's not just about buying when it's going up and selling when it's going down. It's actually more to it. You need to know when to buy and when to sell. So I'm going to show you that. Currency cycling is how we know how to do that. So when price is going down, we generally are told to look for sell moves or shorts. When price is going up, we're told to look for buy moves or go long. Now, that is true, but it's not the whole story. So what happens when price is coming down, but instead we run into a place right here called a range? Now, this is what it will look like on the chart. Price will be coming down, but because we run into a place where buyers and sellers are both in the market, we are generally going to see some sideways movement before we see the steep decline. And so we don't want to sell once it's down here, or we really don't want to sell right here. We really want to sell right here. Now, how do we find that movement, right? So what we want to do is we don't necessarily want to sell coming into a place where another currency is gaining steam. Because what happens if the cycle ends right here and it just turns back around? So we want confirmation, which on the charts, we're told to do what? We're told to buy at a level of retest. We get a breakout, a retest. We wait for that retest, and then we take the position, a buy or a sell. So in this particular case, there's some things out there that can kind of help you cheat, like currency heat wave and some indicators, but those are not super reliable. And the reason why they're not super reliable is because of user error. Okay, if, for an example, GBP, represented by this blue line, is currently higher than JPY, represented by this red line. So if you were looking at currency strength indicators, or if you were looking at the currency heat wave, it would tell you that GBP is stronger than JPY. And so because of that, we would say, well, GBP has strength, JPY is weaker, so we would want to buy, because in the case that the base currency is stronger than the quote currency, price should go up. However, what it's not telling you is where we are in the current cycle. Yes, GBP at this moment would be higher than JPY, but it's also declining and JPY is gaining strength. So at some point, we're going to come to a place very soon where JPY is stronger and GBP is weaker. I hope that makes sense to you. So we don't want to trade simply because one is high and one is low. What we want to do is we want to catch the cycle. We want to see a currency that is stronger and one that is weaker, and we don't want to just enter based on that information. We want to wait until we see this currency come to a place where it crosses into a place of strength. Once we see that the quote currency, in this particular case, the quote currency overtakes, we call this the 50 mark, or we call it the 0 line, critical mass. All right. When we see that the quote currency has just eclipsed, we don't want to wait too long, but when you see it like where it's even, and now the quote currency jumps over and kind of gets that strength, that's when we're looking for positions to sell. Because when the quote currency is stronger than the base currency, price drops. Now, how do we know, how do we recognize when that's going to happen? Well, if this has been dropping and this has been gaining steam, we should have been already seeing strong down movement. When you get to a place where both of them are about the same strength, both of them are similar in strength, like they're right in the same area, Neither one is in control, so guess what happens? We're not seeing strong down or up movement. What we're seeing is sideways movement or hesitation. You'll also start to see where candlesticks go from being very large candlesticks to being very small candlesticks, if that makes sense. And so when you start to see volume come out of the market and indecision come into the market, that's when you should actually be looking for a position. You should be waiting for this to happen so that you could trade the breakout, retest, and then look for the sell opportunity. Because you don't want to take this part of the sell because it could turn around right here. You want to take this part of the sell because it has the strength and the momentum of the quote currency finding strength, and this is the safer move. Okay, so I hope that makes sense so far. Let me kind of get these marks up the screen so you can see. This, guys, is where we want to be looking for positions. This. That's where we want to be looking for positions, right? So if we're looking for a buy, we're looking for currency to cycle. We're looking for the base currency to overtake the strength of the quote currency. And then once it does, we take the position on the buy. And then we get out of the market when we see the market exhaust. Once the market comes back down and we see that position start to get where, it crosses again, and we see that kind of strength shift in the market, maybe we see another base, right? So you have a drop, base, drop. Then you see it kind of down here, and then it rallies. You want to be trading these. That's where you want to be trading, right there. You don't want to be trading this one, or you don't want to be trading in here. You want to be looking for something coming out of a base showing that liquidity has been grabbed and that the strength of the move is going to continue in the direction that you're looking to go. So that's the first part of currency strength. Now, here's the next thing though. Anybody who's been trading for any amount of time knows, guys, the market doesn't move clean like this. It doesn't move just so symmetrically, right? So let's kind of come up here and take a look at how it really moves. When we look at the market, it really generally looks more like this, where, moves are not even and currency strength is not always exactly the same. When one currency is going down, the other one doesn't necessarily mean that it's going up. Sometimes you have two currencies that are going up, right? Like in this case right here, both of them are gaining strength. And so sometimes that happens, and we need to know what to do about those times. And so let's go back to the same principle. What we're looking at, guys, is we want to still trade that, trade those positions. However, what we're looking for is this. When we see price come down, right? So right here, price would be dropping because the quote currency is gaining and the base currency is losing. And so price would be dropping. But as we get closer to that middle area right here, we would start to see price slow down. We'd start to see wicks, and we'd probably see some sideways movement, especially on the smaller time frames. Now, once we see that, guess what we're going to do? We're going to wait. We're going to let the patterns form. Maybe it's a wedge, maybe it's a triangle, maybe it's a flag. We don't know what, it could be a head and shoulders. We can see that stuff form. We take the breakout, retest, and trade this portion of the trade, because essentially we want to ride the momentum of the market and let the market, kind of ride the wave. We want to ride the wave of the market. So if that's the case, what happens when the market is here? What happens when we have a crossover, or like a and I hate the term crossover because it almost sounds like a moving average or something, but I'm really more so talking about currency strength. What happens when currency strength is changing like this, right? Well, how do we know that? How do we know that, like, when the currency strength changes, that we're really not going to have long direction like this? We're not going to have a big move, you know, it's only going to be a small move like this. How do we know that, right? Well, it's actually quite easy. In this particular case, the blue has been coming down. You just saw that it went up but didn't stay up very long, right? And so you had some down move from here. Let's trace this. We had some down move from here. We had a little bit of up move, so it was a nice little pullback. Now it's pulling down again, but it's really not pushing down very hard, and it generally doesn't go down, you know, lower or much lower than it did in previous move. Now we kind of have a little bit of upward movement, and then we kind of have some more downward movement. And so what are we seeing? Instead of seeing a small range like this, what we're seeing is a bigger range like this. And it's still the same principle. Rather than looking for a small breakout on a scalp, what we're looking for is a pattern to form, so that if we can find a flag in there or whatever it might be, you know, in this particular case, it would be a down move. And then you can kind of look and see what currency strength does. And as it does it, we can get our position in there. And then when we get the real breakout, you'll know, because all we're going to see is market structure on the actual candles. And when we get this breakout and the currency really breaks out, what we're going to see is the blue breakout to the downside. And there we go. We're going to get that pattern and we're going to take it to the downside, and we're going to know because we're breaking out of our base that we saw from that back and forth price movement. So that's how you would trade currency strength. You just want to make sure that you're looking for bases. You're looking for, like, when price moves, you're not looking for just a pullback extension, because we all wish the market moved that way, but it doesn't. What we're really looking for is patterns to form, and they don't always just go easily sideways. Sometimes they might go like this, and we get a nice pullback there. Boom. Maybe it looks like this. Generally, we would see that happen and it would go up. So we're looking for those consolidation points or those range points, and then we're looking for the momentum to change. One currency was stronger, the other currency was weaker. Now they're kind of even, so it's been pushing. And then once the other currency takes over strength, I want to put my money behind that stronger currency at that 0 point or at that critical mass point. You can kind of see right in here, I want to look at that critical mass point and I want to see where we are, okay? And so, you know, if we're looking at, if that's even strength, then I want to see where these things are taking place, right? I want to see what is stronger, what is weaker, and are we on the weaker side or are we on the stronger side of the market, okay? So that's currency cycling, and I promise you, if you will master currency cycling, it will take your trading to a whole new planet. When you start to understand how money moves back and forth and how the strength of currencies work, you won't need to rely on indicators anymore or apps or any kind of thing like that, currency heat wave. You'll just be able to get on the market, look for base patterns, and trade the breakouts, and very, very much so simplify your trading. The second thing that Forex YouTubers are not talking about, or not talking about enough, is market sentiment. So when we talk about market sentiment, what we're saying is there bias in the market? And so very quickly, what we're looking at is you really just need to take a look at the whole picture. If I were to show you this, any trader or any YouTuber can come on here and say, look guys, see, it's a downtrend. Well, yeah, that looks good, right? High, low, lower, high, lower. I get that. That's a trend. However, here's the problem with that. A trend is not the same as a bias. A trend is not the same as market sentiment. When we look at what market sentiment really is, it's saying what is the current condition or what is the current bias of the market. Now, if you go onto like Forex Factory or MyFXBook and you look at like a certain pair, GBP, JPY, it'll tell you buyers, you know, it's currently 64% buyers and 46% sellers or whatever it might be. And you can kind of just gauge the sentiment that way. And that sounds really good, and it definitely helps a little bit. You know, MyFXBook's a very good site, very good tool. But the truth is that if you can't recognize it on the charts, you're not going to be able to put it into practice, because looking at a percentage on a website doesn't give you a buy or a sell. It just tells you where, you know, sentiment really is right now. And so when we look at market sentiment, how do we tell on the chart? Well, number one is, yes, that's a downtrend. Yes, that's a downtrend. But the first step is we got to zoom out. And we got to look at the bigger picture. Now, when we see the bigger picture, now we can confirm that that downtrend is truly a market bias, right? Because why? What are we seeing? That when we see a market trend, we're seeing something right here, right? Nice little trend. But when we see it in the bigger picture, now we're seeing, yes, this is part of a bigger trend. However, if you'll notice, it's at an extreme low point, and we're starting to reject. Let me kind of bring it back into where we were and show that to you. But if you'll notice here, we're at that extreme low. Let me drop a line there for you. And when we're at that extreme low, we got there, and now we're starting to push away. Now, does that mean long-term we're going to push away? Well, I don't know. We have to wait and see how price reacts. But what I'm saying is the current bias of the market is that of a seller's market. But it's not because of this trend. It's because of the overall direction and strength of the market. Now, watch this. When we look at that same trend I showed you, this overall picture shows a downtrend, obviously. You know, this is a very, very clear downtrend. You can see that this market is trending downward, and there's no question about that. However, let's talk about, like, for an example, when we look at this area in the market. Now, that was an uptrend, sure, but did that change? Did that change the overall trend of the market? Well, not even a little bit. No. Even when we were here, we were in a downtrend, right? So that's where traders who say, the trend is your friend, always trade with the trend. Well, here's the problem with that is this in and of itself might be a trend, but it is not the trend, right? So at some point, you're always going to be trading against the trend. What do we do? How do we understand market sentiment? Well, here's the thing. Look here. Look at these candles coming down, and look at these candles going up. Which one had more volume? Well, if you said buyers, you're right. Why? Because look at these candlesticks. The candlesticks that are going to the upside are far greater than the candles that are coming to the downside. And so in that moment of time, the current sentiment was a buyer's market. Now, that does not mean that the trend is a buyer's trend. It's telling you that the current condition of the market is that of a buyer's market, but we're in a seller's trend. Why does that make sense, or why does that even matter? Well, because if we can understand that on the 1 hour chart that we have a seller's trend, but a buyer's sentiment, then here's what we can do. When we start to see that, we have a seller's trend, but a buyer's sentiment, that tells us that trend is bigger than sentiment. So what we can do is come down to a smaller time frame, like the 30 or the 15-minute chart, and we can come to that area and start looking for positions in the opposite direction. Or another thing we can do, depending on how early we can catch it, we can come in here and we can start looking for opportunities to catch those breakouts on the next move up as the currency cycles. If we know we have a seller's trend but a buyer's sentiment, we can wait for currency to cycle, like I talked about a few minutes ago. Wait for currency to cycle right here in that base, and when it breaks out, we know we have enough sentiment left at least to grab a scalp. Now, I would not tell you to go and take a long day trade or swing trade position against the overall trend, but you can use market sentiment to go ahead and scalp and grab some nice movement out of the market. If you were to take that breakout and just be quick in and out, that's 23 pips right there. Very quick. Within just a half hour, you could have grabbed 23 pips in and out of the market. Don't be greedy, get out. Why? Because the sentiment told you that the buyers were in control. And until you see that those candles start to slow down, and until you see that we have a change of market sentiment back to a seller's sentiment, then you can take a scalp against the overall big trend. Now, why do people tell you not to trade against the trend? Well, because they don't want you to lose money. I get it. But here's the thing. When we look for those positions, we can make really good, profitable moves by simply going with the flow of the market. Okay? Here's another example. If you come back over here, if you look at the overall picture, we had buyers' sentiment, and this area right here was a cycle. This was a whole cycle. Look at that. Now, it had cycles within it, but this whole area was an area of indecision. Why? Because we had a big buyer's sentiment within a much bigger seller's trend. So when you have that, you're generally going to have, when you see that in the market, your downtrend means that your pullbacks are going to be small. But when you do get the big buyer sentiment, what's going to happen is on the upside, when it gets here, it's going to be spikes. Big wicks, big spikes, like you see right here. Like you see right here, right? It's not taking a long time. But when you get up here to where the buyer sentiment in the seller's trend, the buyer sentiment, it's going to end up basing out. Why? Because buyers are not stronger than sellers in this case. So when you see that base, you trade it as the currency cycles and get back in the move of the trend. That's where you get your big moves, your day trades, your swing trades. But you can scalp with the sentiment against the trend. So trend and sentiment are not the same thing. Trend is the overall direction and strength of the market. Sentiment is the current condition and bias right here, right now. The third thing that Forex YouTubers are not talking about, and you're wait for it, because some of you are going to say, wait a minute, yeah, they do. Trust me, stick with me for a moment. The third thing is risk management. Well, you're going to immediately say, well, I've heard my Forex YouTuber guy talk about risk management. Well, let me tell you, there's a difference between having you use risk management and just telling you, use proper risk management. Like if somebody sends you out a signal and then just says, use proper risk management, that's not enough. I'm sorry, it is not enough just to tell people to use proper risk management. It's just not enough. How do we use risk management? And the truth is, if you don't have a risk management plan, then you don't have risk management, right? Risk management is a part of your trade plan. So when you created a trade plan that says, maybe I have these 5 confirmations that I look for, this is the type of trades that I take, these are the pairs that I trade, whatever your trade plan involves. And if you're looking for a good trade plan, you can go on my website and get my trade plan. Go to tradeandgetpaid.com, click on the store, and you can go to get my trade plan, and you can base it on that. TGP members, you have that for free. It's in the downloadable content, so you can use mine as a template. But if you have a trade plan and it only consists of strategy and not really risk management, and I'm not saying use good risk management. I'm saying like detailed breakdown of what that means, okay? Then you don't have a completed trade plan. So when we talk about risk management, what I'm saying is that it's not enough to just say, well, I'm going to use good risk management. So the first thing we're going to do is we have to understand how much of our account are we willing to trade in any one trade. Just saying that we're going to have, if you have $100 in your account, you should be using a $1, or $1,000 in your account, you should be using a $1 lot size. Man, that's garbage. Because here's the thing, you're using a $1 lot size, but let's say you're swing trading and your stop loss is 60 pips, right? So you're risking $60 just in your stop loss, plus your commission and your fee to your broker. So really, you're risking probably somewhere in the neighborhood of like $65 to $68, 62 to 65, somewhere in there, right? And so if you have $1,000 account, you're risking a good, 6% of your account in one trade on a dollar lot size. That's not, you're risking 6%. That's crazy. So you can't just say, if you have $1,000 in your account, use a dollar lot size. That don't make sense, guys. What you really want to do is you want to say, I'm going to risk 1% or 2% or whatever that looks like for you. What is the percentage you're willing to risk in every account? For me, I trade 1% of in every trade. So let's say you have $1,000 account, okay, and you're trading at 1%. What that means is that in every trade, just take 1,000 and divide it by 100 to get 1%, right? And that tells you that your answer is $10. So that means I'm gonna trade $10. Man, forgive my beautiful handwriting there. Let me make that a little nicer for you. So you have $10 total risk. So now going into a trade, you already know what the possible loss is. Add maybe your broker and your commission to it. So now in this smaller risk, maybe you're gonna be risking $11 or $11.50 or something like that. So you're just over 1%, okay? If you're at 2%, you're at $20. So now you're not taking it and basing it on lot size, you're basing it on percentage. So now, how do you know what lot size to take? Well, the first step would be go look at your trade. And you look at your trade, and let's say you're looking at a position and you're coming down and you're gonna be trading away from this level right here. Well, if your stop loss is gonna be here, how big is that? If that stop loss is 10 pips, well, guess what? $10 divided by 10 pips equals $1. So now you know you should be using a $1 lot size. But what if your stop loss is 20 pips? You don't want to use $1 anymore. Now, $10 divided by 20 pips is a 50-cent lot size. So your lot size should fluctuate with whatever trade you're getting into. And so you can do very simple math, have your calculator up on your screen or on your phone or whatever, while you're getting ready to get into your trade. Have that stuff preset. Know where the structure is, right, before you ever get into the trade. And you can adjust it by 1 or 2 pips if you need to, depending on what kind of candlestick entry you get. So it's not like you don't know ahead of time and you're like trying to calculate it in the moment. You know where this is. So do the math. Don't be lazy. Do the math and, go in there and get that done the right way. Now, the next thing is, I know how much I'm willing to risk. I know what my percentage is, and I know what my lot size is. Now, how long am I willing to stay in the trade, and what is my risk reward? So for me, I like to have a risk reward of 1 to 2. Okay, so that means every one that I risk, I'd like the reward to be 2. Now, it doesn't always work out that way. Sometimes it's 1 to 1.68, or 1.9 or something like that. But if it's like, I'm risking 1 or I'm risking 2 to get 1, that doesn't make sense. I'm not going to risk more than the market will give me in return. That doesn't make sense to me, right? I would never go into an investment and say, I'm going to invest $10,000 and my possible reward is $1,000. That wouldn't make sense to me. I'm not going to give 10,000 if I can't make at least 10,000, right? So a risk to reward is for me, it's 1 to 2. What is that for you? If you're a scalper, maybe you like 1 to 1, and that's okay. A lot of traders are 1 to 1, and that's okay, right? There's nothing wrong with a 1 to 1 strategy. I just personally like 1 to 2. So that's the next thing you need to figure out. You need to have that mapped out. 1 to 2 risk reward. The next thing is, what is my exit strategy? So if I enter a trade and my stop loss was here, in fact, let me do this with lines so you can kind of see it a little bit better. My entry is there. Let's say my stop loss is here and my target is here. Okay, so let's make this red so you can see it, and let's make this blue because we want to win. Go blue. And so we have this entry. So here's the problem. We enter the market, and let me get this this writing tool back. Right, we get in, we get the entry, here it is. We put our stop loss at whatever structure, and we start to move into profit. Well, so right here, we're looking really good, because when we enter that trade, just look. When we enter that trade, we look here, and we're looking beautiful. Look at that. We are at a 1 to 2.5 risk to reward. But the problem is, as price starts to move into profit, look now. Look how much we have at risk. Yes, it's some house money, but why give it back? Right? As price continues to drop, as price continues to move into profit, man, you did a great job. You marked up a nice trade, and now you're in major profit. Well, guess what? Now look at where this risk is at. So here's what you do. You want to have a plan in place that says, once I get, if this, for an example, right here, if you're looking for, 40 pips, once I get 10 pips of profit, what I'm going to do is I'm going to take 25% of my position out. So if I was in at $1 lot size, I'm going to close 20.25, and I'm going to go ahead and take out some of that so that I'm now at a 70 or 75%. Maybe you just want to take 50% out and go to a 50-cent lot size at that point. So now you already got, some of that money's already in the bag. And as that move starts to push, I'm gonna bring my stop loss closer so that I can secure the bag, right? So now my stop loss is at break even, and I've already put half of my money in the bank. So now if price was to turn around and go and hit my stop loss, well, man, the worst thing I can do is make money. The worst thing that can happen is that I won on a 50-cent lot size, and that was that, right? But what if it doesn't? What if it keeps running? Well, guess what? I'm going to come and when I get to a place where I'm 30 pips in, let's say, I'm going to close another 25%. Then I'm going to move my stop loss into structure where, whatever makes sense, where the structure's at. And as we get to a point where, look at this, as we get to a point where it just doesn't make any sense anymore, well, I'm just going to close the trade. Or what I can do is I can take that down to a 10% position, put my stop loss in place, take my take profit completely off, and just let it run. And when you see it gassing out, take your profit and run. Take your profit and go, right? And so that's a great way to have that mapped out to where you can make sure you secure the bag. and you don't lose your money to the market. You need to have risk management in place, and that needs to be mapped out as a set of rules before you get in the market. Don't wait till you're already in and now you're wishing, come on, 5 more pips, 2 more pips, 3 more pips, 5 more pips. No, come on, stop. That's whack. What you want to do is say, at 10 pips, I do this. At 20 pips, I do this. At 25 pips, I do this. At 40 pips, I'm out. Whatever that looks like, whatever your structure, you need to have that in place, and risk management needs to be there so that you can guard yourself from overexposure. Another thing is your trading frequency. How many trades am I willing to take? Maybe I trade day trading, and so I just want to take 1 position per night. Maybe I'm a scalper and I want to take all sells because I saw selling, seller sentiment. So I'm going to buy every retracement, or I'm going to sell at every retracement so that I can scalp, get out, scalp, get out. Maybe I'm in a buyer's market, or there's some buyer sentiment in the market. And so I'm going to buy the dips. Every time the market pulls back in dips, I'm going to buy it, wait for it to extend and get out. Buy the dip, wait for it to extend and get out. And I can do that over and over. What do I mean? I mean, when the market's pushing up, I wait, it pulls back, I buy. It pushes up, gets back to here, I'm out. That's scalping. It pushes up a little bit more, but yeah, you don't know how far. Pulls back, what used to be a ceiling becomes a floor, I buy. Get to here, I'm out. That's a scalp, right? It runs a little bit more, I'm out. It pulls up, boom, I do it again. Do it again until it's just not there anymore. If that's your strategy, you need to determine that. You need to determine if scalping is going to be the thing you do. If day trading is going to be the thing you do, then what you're looking for is the best trade of the day. So if you say, I got 1, 2, 3, 4, 5. All right, here we go. Here it is. That's the one trade I take. Enter and take profit, right? So, and that's my trade for the session, 1 trade. Don't do anything else. If you're a swing trader, maybe you're looking for the 2 best positions of the week. And so you're going to look at the week. You're going to see that we're in a big buy, but we're just about to pull back right here. And so boom, there you are, and you sell. You take that 1 position, get it, wait for it to finish, and then you analyze and see, do you want to take another one, right? And so you need to understand what your trading frequency is. That's part of risk management. So guys, I want to encourage you to have risk management mapped out. Have a set of predetermined rules that this is what I'm going to do when the market does this. How do I react when price goes against me? When price hits my stop loss? Am I done for the night, or am I going to try to get another position? If price is in profit, I'm going to trail my stop and I'm going to scale out of a trade. Whatever that is for you, you need to have that mapped out. And I talk about that a ton in my classes. So, feel free to join my class and check that out. But you need this stuff in place if you're going to be a successful trader, guys. Risk management is the most important thing we have when it comes to being a Forex trader. All right, guys, so that's the 3 things that Forex YouTubers are just not talking about: currency cycling, market sentiment, and yes, risk management. So I hope this video brought you value. I know it was a little bit longer than normal, but I wanted to give you something that was really valuable, put something in your hands that would really help you. And I hope this video will help you get to the next level. If you have any questions, feel free, comment below. Let me know which one of these things that you found the most valuable to you and what you can do to put it into practice. And if you're ready to take your trading to the next level, go ahead and become a student today. Go to tradeandgetpaid.com, links in the description. I'm telling you, our classes are fire. We got trading courses, live trade setups. Every time I trade, I'm sending it out to the team. We're doing all kinds of special classes together, and the team is winning together. I'd love to see you in there. For now, guys, I'll see you in the next video.